Treasury yields today putting pressure on the market. The 10-year hitting its highest level since late April earlier today. Our next guest digging into the charts to see how much more pain the bond market could inflict on stocks. Renaissance Macro Research Chairman Jeff deGraaf joins us now. That's the main culprit here? You think this backup in yields in both the 10, the 30, I mean, almost all along the curve?
I do. I think it's important, and you're seeing it in those areas that are, most sensitive to rates. The two exceptions being banks, but I think that's a deregulation story, and utilities, which I think is a little bit of an AI story. But other than those two one-offs, our sensitivity work that looks at what gets most impacted by rates and one deviation moves in rates is pretty consistent.
I mean, it's obvious the kinds of sectors I suppose that you would look at, utilities, REITs, and things that are proxies for yields. But how deep does this end up going, do you think, if rates remain either this elevated or back up even further?
Well, I mean, that's the billion-dollar question right now. And
that's why I'm asking you. You got the billion-dollar answers.
Of course. So we have to get through 475, right? So that's a pretty important number, and I know we're right there. So that's an important number for nominal yields. I think one of the things to watch right here, and this is good news actually, is we're not seeing these higher nominal yields push their way into credit spreads, right? So if we look at double B versus triple B spreads, they're still very close to the cycle lows. If we look at just corporate spreads versus the Treasury, those are also very close to the cycle lows. So what that says, sooner or later, higher nominal yields will start to hit aggregate demand, and that then starts to slow things down, and you start to see those spreads widen. That's not happening yet, but I do think that the elevated risks of a policy mistake are certainly in play, probably the highest that we've seen, if not for this cycle, at least for the last 6 or so months since the Fed first cut rates back in September. So I think we're right there, and I think the market is telling us that it's teetering on this differential, if you will, in terms of valuation and earnings yield and what you're able to get from the Treasury with obviously substantially less risk.
The tech's getting just destroyed today. NASDAQ's down 440. As I asked you that question, saw 2.25%. Many of the biggest names, obviously we led the show with NVIDIA hitting this record high, crossing Apple for the largest market cap company in the world. Now I look at the lows of the day down more than 6%. Right. Where's this trade going from here, according to the charts?
Well, I'll tell you, NVIDIA is really the standout for semis, right? When we look at semis, and we've been more cautious on semis for at least a quarter now, NVIDIA kind of being the exception to that rule. That's still an uptrend. I think there's a ton of support down around 125, so that's good news. But when we look at semiconductors, holistically, from everything from Qualcomm to Intel to NVIDIA, the group's not that strong, and so I think there is a cyclical component to it. They're as overvalued as they were in our work back in 2000. Then NVIDIA barely existed. It was more the Qualcomms and the Intels of the world. So just as a reminder to viewers that technology is cyclical. There are new winners and new losers in every cycle. But I do think that of what we're seeing in technology, I do think semiconductors are one of the more vulnerable spaces. We're focusing our efforts and suggesting to our clients to remain in software and to look at adding to exposure there. They look better.
Do you think the market in any way is onto, if you will, what's about to happen over the next handful of months and the volatility that could happen as a result of the new administration coming in? New policies that he wants to get done quickly, tariffs that could happen sooner than people maybe are willing to believe, or the size of which, the scope of which, the strength of which could be a little more unsettling. What the talk of tax cuts could mean for rates going up even further. I mean, do you think the market's onto that? As positive as the outlook still feels like it is, I'm not saying the trend is all of a sudden going to reverse itself, but the market seems to be onto something.
Look, I make my living by believing that, right? So I believe that the market is a discounting mechanism that, it might not be obvious to us today what the market is pricing in for next month or even next year, but that the market is omnipotent in its wisdom. And so I do think that there's something there. Now, the good news is, we look at what we call the policy uncertainty index, or we don't call it, we use it, from out of Stanford. It's called the Baker, Bloom, and Davis Policy Uncertainty Index. What's refreshing, Scott, is when you look at policy uncertainty, when this is spiking, right? So uncertainty is high. When we look at that out 3-6 months, it's actually very bullish for the markets. In other words, by the time uncertainty hits us today and we can kind of, quantitatively analyze it, it's too late to do anything about it. And you actually want to be an investor in those high uncertain times, because usually it ends up ameliorating itself over time, right? So I look at policy uncertainty and that unknown actually as being a little bit more bullish. Now we are, and we did start the year off from an oversold condition, so that's good. It's a minor oversold condition. It's not a deep oversold condition. So I like that. I actually think probably the biggest impediment to equities for 2025 is just this wall of worry that's been extinguished over the last year. We started 2024 with a lot of skeptics, a lot of skepticism in the market. We were pretty bullish for 2024. We're starting 25 not in that same mental state. And I think that expectation game is probably going to keep us into more of a consolidation / correction in the first quarter. But I do think that ends up resolving itself for the remainder of the year.